Welcome, members and guests. This is Jane Chen, Vice President of the Virtual Investment Club of Sacramento, VICS. I am facilitating the meeting today in absence of Joanne Obeta, President of the VICS. We are a better investing model club open to the public. All of our meetings are virtual, allowing us to have members from around the world and the US, including Canada and China. Guests, you will be muted during the meeting as observers and will have an opportunity for questions and comments once the meeting ends. The stocks presented today are for educational purposes only and are not intended to be a recommendation for buying or selling any stocks. We ask that you conduct your own review and analysis of any company of your interest before making an investment decision. The views expressed here do not necessarily represent those of Better Investing. This meeting may use products or services not endorsed by Better Investing or the club. This meeting is also being recorded for future use and will be posted to our YouTube channel. So welcome, thank you. We have Haney for Treasurer's report. Thank you, Haney.
Okay. Okay, thank you, Jane. Let me just, sorry, I have to. Okay, so I'm just going to do a quick overview of our portfolio. This is taken from most of the reports you'll see that I'll present are taken from my iClub website, where we track our VICS portfolio. We also use Morningstar, and to a lesser extent, we use Manifest Investing. So this graph just will show the shows the the different sectors, super sectors and sectors. We have quite a bit, about 52% of our portfolio in the sensitive super sector. We also have a fair bit of cash, and the portfolio is spread around a number of different sectors. I won't go into that a lot. Here is the actual companies. You can see that one of our largest holdings is Facebook, and then again, lots of cash that we need to deploy. Skyworks is the second largest holding. Last month we voted to purchase two stocks, Algonquin Power and Tencent, and we usually purchase stocks on the day following the meeting using the opening price, and every month we deposit $1,000 into our virtual account. However, last month we decided to wait until Tencent went down below $40 before we bought it, and so I was watching it for a few days and noticed that it was going down. As you can see, September it was going down here, and then, to be very honest, I forgot to look at it for a few more days, which was a good thing because it dropped down further, and we ended up buying it at $34, and which it's starting to go back up now. Algonquin was purchased the day after the meeting at $10.53. Again,
hey,
yes.
Where are these graphs coming from? This is good work, but I just wonder where the graphs come from.
Sure. These graphs are taken from stockcharts.com.
Thank you.
Okay. So just at a very high level, we have we've invested about $22,000, and we have $5,000 roughly that's not invested. The current value of the portfolio is $25,699 for a gain of $3,500 roughly, and that's an absolute return of 16%. However, absolute return just is the difference between these two numbers, the 22,000 and the 25. So what I did was I took all of our transactions, put them in a spreadsheet, and calculated an internal rate of return based on the cash flows. And right now we have about our return based on that is 14.7. This report is taken from iClub, and it's called the gain loss report. And it shows here in the second last column on the right, the actual dollars gained and lost, and then in the last column, the percentage. The three best performing stocks are Facebook and HEICO and IPG Photonics. These other three, Bank of the Ozarks, Public Storage, which is a REIT, and Tencent are down. Tencent, I think, is down because of the trade disputes that are going on. Overall, again, we've gained about 16%, but that's on an absolute value basis. This report is called a portfolio report, and the main column to look at here is the projected total return. So the stocks that I've highlighted, HEICO, Disney, PSA, Five Below, and IPG, those are being projected at low returns. These are the returns over the next maybe 5 years or so. So they look like they're going to underperform if these numbers are correct. And then the rest of the portfolio is showing stronger returns. So when we look at these, we usually start to think about what actions should we take? Should we be maybe doing a stock study on them to see if in fact these returns are correct, or should we be looking to sell? So just more for information right now.
Why does Biogen show not applicable?
I'm not sure. I don't think they did a return on it. So these are analyst estimates, and sometimes they don't have an analyst estimate for it. But that's
okay.
I noticed that, Roy. I'm not sure exactly, or sorry, Tom. This is a new report. It's called the Sold Securities Report. I just came across this. I was playing around and came across this. It's an interesting report. So what this is showing is we sold these companies here, CVS, High Crush, Middleby, and Realty Income. And so it's showing how much we made, gain or lost on each one. But it's also showing what the return has been since we sold those holdings. So you can see that we sold High Crush, we had made a 60% return, but since selling it, it's gone down by 56% from the price when we sold it on the 522, and then Middleby is the other way. We had lost 20%. And since selling it, it's made 84%. So maybe we should have hung on to that. The other two are kind of insignificant. So I thought this was kind of interesting because it helps us to gauge our judgments on when we decide to sell positions. So I've talked about some of these things like returns here.
That was very neat, but Hanny, where do you get that? That's an interesting thing there. You can look at what you sold, what happened to it, and where'd you get that chart?
This is from our iClub account. So we all have access to that through. I think Roy had sent out some links, but that's from iClub. And if you go to our portfolio on iClub and reports, on the left-hand side, you'll see quite a few reports, and it's just a matter of this one's called the Sold Securities Report, but you can play around with them, and there's some quite interesting ones there. So I just thought I'd show that.
Yeah. Right.
So this is just a quick thing. There's a number of ways that we're expressing return, and there's I had to do this internal rate of return, and we might want to at some point in the future consider comparing these returns so that we're all have the same understanding of how these are calculated. That might be a good education topic. So that's the treasurer's report. Any questions?
Thank you. Thank you.
Any question? Any question?
Oh, does the return include dividends?
Dividends. So this that's a good question, Jay. This one where I wish I had my spreadsheet here. I'd show you exactly, but so it indirectly includes dividends because what I did with the internal rate of return is that you buy the stock on a certain date, and then sometime in the future it has a future value. That future value includes the dividends. So the way that iClub is handling the dividend transactions is they're automatically reinvested, and so we have more shares, and so the value goes up because we've reinvested that dividend into more shares. And so when you do the internal rate of return calculation, you don't put the dividends in, it's automatically included because the value has gone up. So to answer your question, yes, it does include dividends. Okay,
Great.
that's it.
Yeah, thank you, Haney. Haney has kindly agreed to educate us on preferred procedures. So again, Haney, over to you, educational.
Okay, I'm hoping that I don't lose my voice by the end of these things.
That's
Okay, so I'm going to talk about preferred procedure today, and before I do, I just want to recognize Ann Cunias, who has done a really good education topic on this, and I borrowed a lot of the material that she had put together, and I kind of summarized it. So a lot of this, if you've looked at her education segment on preferred procedure before, you might recognize some of the slides, and I just wanted to give her credit for that. So a quick agenda. I'm going to talk a little bit before I get into the preferred procedure. I'm going to give some background, talk about analyst consensus estimates, the income statement, and then finally I'll get into the actual preferred procedure and how you use it. And I want to thank Bernard because he had asked for this a while back. So I had promised to do this with Bernard, and so instead we're doing it as an education topic. So first of all, just so that everyone is on the same page, what are earnings? Earnings are simply the profit that a company makes. So earnings are the same as profit, same as net income or bottom line. All of those terms mean the same thing. And in very simple terms, earnings are just the revenue that a company gets from selling a product or a service, less the cost that's used to make that product or deliver that service. Earnings per share are just the net profit after tax divided by the total number of diluted shares that are outstanding. So I think most people know that, but I thought just so that we're all on the same page. So why are earnings so important? Well, if really when we invest in a company, what we're investing in or what we're paying for is the future profit that company makes. And so we have to make sure that we analyze the potential for a company to grow earnings, and because that will impact the price of the shares in the future. So earnings are considered the most important variable in influencing share price. You hear a lot in the financial media. If a company misses earnings, the stock usually drops significantly, and if they beat earnings, it typically goes up. And we use earnings in the stock selection guide, SSG, to calculate a future high price for the stock and see if it's worth investing in. So there was a study done, and that's what the graph on the right here is showing. So it shows the earnings per share appreciation for the S&P 500, and this is long-term projected earnings, and as they go up, the share price goes up significantly. So it's not a one-to-one relationship. The earnings went up during the study period by 18%, and the stock price appreciation went up by 71. So so they do impact stock price, future prices significantly, and that's why we pay a lot of attention to them. There's
Now that
different
would be
ways.
a case of PE expansion, right? The PE would be much
Yes,
lower at the beginning than at the ending.
exactly,
Yeah.
exactly.
That's
There are three basically different ways to forecast earnings. One, on the stock selection guide, we can see a graph, and we usually extrapolate that graph to a certain number of years in the future. That's not always the preferred way to do it. It's the unpreferred way because the growth rate is not constant. So when you look at some of the graphs on the stock selection guide, and I'll show those a little bit later on, it's linear, it's a straight line, but the earnings fluctuate from year to year. So it's not always accurate to do it that way. The other way is what's called ACE, or Analyst Consensus Estimate. Again, that has some challenges because a lot of the different analysts have different financial models, they use different assumptions, and a lot of them will only forecast a couple of years out, or one or 2 years. When we do a stock selection guide study, we're looking at, we need 5 years, and so sometimes 5-year forecasts are not always available. And they don't really explain how they generate these forecasts. Now, you can see on the screen here, I've got some logos from different companies, Zacks, Morningstar, Reuters, and Value Line. These are the main ones. There's also S&P Capital, but their reports are hard to come by. But these four all provide 5-year estimates. And so they're a good source to look at. The third way to predict future earnings is the preferred procedure, which we'll talk about today. And the first thing we need to do is estimate the potential sales growth for a company, and we use that as a starting point. And there are 5 different parameters that we estimate, and I'll get into this a little bit. So first of all, I want to just talk about these analyst consensus estimates, or ACE. The best source is called IBES, Consensus Estimates. That's a service that was purchased by Thomson Reuters, and basically what they do is they just collect, they have access to all of the analysts that cover the various stocks, and in North America and around the world, I think there's tens of thousands of them that they collate, and they for each company they'll compile the estimates. And what they do is they just do some statistical analysis. So they look at the high, low, and medium, and sometimes they'll do the average of those estimates, but they don't do any other calculations. So it's more just a collection of these things. And these consensus estimates really provide they give you the annual growth rate over a 3 to 5 year period, and it's really important because we've done a lot of stock studies, and I think there's a little bit of confusion on what these growth rates are. Are they they're annual? So yeah, if something is growing at a rate of say 10%, that's 10% every year for 5 years. So the numbers that you see on a stock selection guide, if they're showing a long-term estimate, those are per year, and that's important because you can see on some of the companies that the growth rate is quite high, and you have to apply that, and you have to use some judgment to see if that makes sense or not. If a company can grow earnings at a high rate for 3 to 5 years, so it's a compound annual growth rate per year for 3 to 5 years, typically. This is an example of the IBES estimate from Thomson Reuters. I can't remember which company this is, but you can see here they're projecting 3 years out, and this actually might be Lam Research, which is yeah, it is. Sorry, it is Lam Research. So they're projecting fiscal 2019, 20, and 21. And they're giving the mean in this case, which is the average. They usually take the medium, the midpoint of the estimates, because that's more accurate. If you have numbers that are too high or too low, the average will be impacted by those. But if you take the midpoint, then you get a more accurate sort of result. And then here they're showing the previous mean, the number of brokers that are presenting these estimates. They give the range, high, low, standard deviation, and so on. And then they compare it to previous years. And you can see here the chart. So the last 3 years, and then 19, 20, and 21, they're projecting into the future. So this is a good source of getting these forecast earnings, because you know, it's you're getting a good cross section from all of the analysts. Now, how accurate are these things? Well, as I said earlier, most analysts don't provide a basis for the calculation, and they don't state their assumptions. There was a number of academic studies done, and one of them found that there was an absolute error of over 90%. And again, Reuters uses the medium value, not the average. And again, that's to eliminate the numbers that are either too high or too low. So if there's this much error, are these things actually any value? And the answer is yes. They have their problems, but they are a data point along with other sources, and as long as we can use judgment and we can compare and see if the numbers make sense, then it gives us another data point to look at. So if you look at them over the long term, they're maybe not accurate, but we don't know how far off they are. And there are a number of studies that looked at the accuracy and the absolute error of these things over historical data. And a lot of people believe that it doesn't really matter as long as you get sort of the trend or the general trend. So, and that may be another education topic that we might want to look at. So I'm just going to talk about the income statement now and how we get from the income statement to earnings per share using some of these. So first of all, just a quick overview of what an income statement is, and I apologize. This is fairly straightforward and basic, but maybe not everyone knows this. So I'll just review it quickly. So if we take revenue of a company, their sales basically, we subtract the expenses to generate those sales, we get a profit before tax. So in this case, there's sales are $1,000, expenses are $800. There's a pre-tax profit of $200. Depending on what the tax rate is, so in this case it's 30%. That in this example, so 30% of 200 is 60. So that's the tax. We have to deduct that tax from the pre-tax profit. And if there is a preferred dividend, we have to subtract that as well. So preferred dividends are typically, if a company has common shares or preferred shares, the preferred shares they get paid out first, and then what's left over goes towards the common shares. And so that's why, while preferred dividends are not a cost, they're shown on the income statement because what we're trying to do is figure out how much earnings are going to be left for the common shareholder. So they're subtracted out. But most companies don't have preferred dividends. So, but if you do come across one, then that's why we subtract that. So just going back, we have a pre-tax profit of 200 and taxes of 60, preferred dividends in this case of 10. So the net income is 130, and just used 100 shares, and so the amount of earnings per share is $1.30. So that's a simple income statement, and you'll see this again, and you'll see it in the preferred procedure. So it's just good to understand how it's calculated. Any questions so far?
No.
Okay.
Yeah.
So this
Where
is,
can a person get this IBEST data? Can we get it on our own?
yes. So I get it from my brokerage account, and so if you have, I have actually an E-Trade account, and they usually have it. Other brokerage might have it as well. I don't know if it's available through libraries or not, but I know that through some brokerage firms they make it available.
Thank you.
If you ever need it, Tom, just let me know. I can certainly give you a copy.
Thank you.
Lamb Research is the stock that I used as an example, and this is their statement of operations or income statement, and they're showing the last 3 years here. But I just want to compare this to this simple income statement. So one is revenue, and you can see that at the top. Then these E's, the red E's, represent all of the expenses. So you have the cost of goods sold, which is basically the cost to make whatever it is that they're producing. We'll talk about that in a bit. They also have quite a bit. They spend quite a bit on research and development. That's a cost. And then there are general expenses like advertising, their facilities, and so on and so forth. So that's or SG&A, it's called, which is selling, general, and administrative. And then there's some other expenses. You have to go to the notes to the financial statements to find out what's included in these. But if you subtract these 4 items, that's your total expenses here, and you get a pre-tax profit. And it works out to, if you divide this number 3,151,789 by the revenue, you get 28%, 28.5. So that's the profit before tax. Then this line number 3 is the tax, the income tax that they actually paid. And if you divide this by the pre-tax amount, you get a tax rate of 24.5. And then down here on the income statement, again, they show the basic, the net income per share, okay, here's the number of shares, the basic and diluted. So diluted shares are typically, like, if there's, say, someone has stock options or some management is holding some shares and so on, they're not typically included in the basic shares. So the diluted is the total shares outstanding. If you divide the net income here by the number of shares, you get the earnings per share. So again, that's just referring this consolidated statement or income statement to the simple one. Lamb doesn't have any preferred dividends, so you don't see it on here. But you can see it's not that complicated if you just go through this and identify the costs and net those out. It's fairly straightforward. So it looks intimidating on most balance sheets or income statements, but it's really not that hard. So again, I just want to pre-tax profit margin, because that's a number that we use a lot, and that so it's we take the earnings before tax and divide that by the revenue, and we get the pre-tax profit margin. So in this case, that's these two numbers, the 3151 divided by the revenue, and it equals 28.45. So that's how I came up with this number here. Okay, so what does that mean? It means that for every dollar of sales that Lam Research has, they earn about $28.50 of profit, and $72.50 is spent on various expenses. So that's important. So now we're going to talk about the preferred procedure, which is a financial calculation, not a surgical procedure. What is it? It's a method of calculating the earnings per share of a stock 5 years into the future. Now, it's important to make the distinction that what we're trying to do is calculate earnings per share, not a growth rate, because we see on the stock selection guide a growth rate, and a lot of people think that that's what we're looking to get. But what we're really looking to do is calculate the future EPS, and again, we use that to project high price. So in looking at this income statement calculation, it's very logical. It kind of flows, and that's why we use the preferred procedure. It's recommended by BetterInvesting. It's called preferred because it's a logical way to arrive at these earnings and validates our assumption. So how do we go about doing that? Well, we need 5 things. One is revenue, the pre-tax profit margin, the tax rate, preferred dividends, if any, and the number of shares outstanding. So exactly what we had talked about in the income statement. So very it matches 1-to-1. So really what we're doing is when we do the preferred procedure is we're generating a future income statement for the company. So here's an example again. Lam Research, we have the 2018 revenue. I extrapolated at 8% for 5 years, and we get 16,276. The pre-tax profit margin in 2018 was 19. I said that it's going to improve to 25%, and I got that from looking at their 10K, their annual report. Tax rate went down because of the tax act in the United States, and diluted shares. They've been buying back shares. So in 2018 they had about 180 million shares, and just projecting again, they're based on their buyback. They're going to have about 175. So what's the earnings per share in 5 years time based on these assumptions? So we do an income statement again, revenue, expenses, which are 75%, pre-tax profit is 25%. So just working those two out. Taxes are 20% of this number of the pre-tax profit. There's no dividend. Net income divided by the number of shares, you get $18.60. So fairly straightforward, exactly again like the simple income statement that we just talked about, but it requires a lot of calculation. So we just let the stock selection guide do all of this work, and here's a screenshot of the SSG for Lam. Somebody has a question, sorry.
So we're talking about 5 years out? 5 years out, Haney?
Yes.
Okay, thank you.
Yes. Okay. So in 5 years, we're forecasting that sales are going to grow at 8% per year, and so if I take this number and add 8%, I can't do the math in my head really quick, but, and then, so that would be 2019, and then I take that number and add another 8% and another 8% 5 times. So it's compounded. We'll end up with this 16 number for revenue. So, but the software does that automatically. You could see it here. So if I put 8% as my judgment for the sales growth, I get this 16 billion in revenue. And then expenses, 25%.
When it says 8 judgments, that's
my
8
pre-tax
analysts.
profit.
When it says 8 judgments, that's 8 analysts.
What?
Or
Sorry.
when it says 8 judgments.
No. That's so judgment is the number that I'm putting in for the annual growth rate of sales.
Okay.
So it says
thank you. Yeah.
projected 5-year. So if you look back here,
Yeah.
we started out in 2018 with about 11 billion, and we're going to grow that at 8% compounded. And so that gives us in 5 years 16 billion. And so in here, I just put the 8%, which is my sales growth rate on an annual basis, and I get the 16 number, which is what I had before. Yes.
Is there any chance you can go to your SSG for LAMs now so they can see how you decide 8%, 25%? Because it's all provided in
Sure.
the SSG.
Yes. I can certainly do that. Okay, so I'll close this. But so here's LAM, and let me just make this slightly bigger. If you can see that, okay.
Yeah.
Now I'll get so in here you can see here in the stock selection guide. First of all, this is the sales. Here's the pre-tax profit and the earnings per share historically, and analyst consensus estimate. It's giving a 2-year sales estimate of 20%, and that's per year. And the earnings per share long term, and long term usually means 5 years, is 9.7. So I was being very conservative. I said, okay, for 5 years, if it's growing at 20% for 2, and I can show you where I got this 8 later on, but I just decided to be conservative. So I said every year for the next 5 years it's going to grow at 8%, and so I put that in. And then here I have a number of choices, but I click on, so I can put my own, I can put the analyst estimate for the earnings growth rate. But what I did, I clicked on this box, preferred procedure growth calculation. And it as soon as I put 8 here, it comes up with some defaults, which you can change. So I put 8%, 25% for pre-tax profit margin. Then the tax rate, and you can, these graphs, sorry, on the side show the historical trend. So you see this curve is basically a chart of these numbers. If I look at pre-tax profit margin, was minus 23 in 2009. It's going up, and you can see the trend here, and it's 28.5 in 2018 now. I did a bit of research, and it tells you here to take the 5-year average. So you take these 5 numbers from 2015 roughly, or 2014 to 2018, you average those. The software already does it for you. It says 19.4, but I actually went to the 10K, the annual report, and management was projecting a higher profit margin. So they're getting more efficient at running the operation. So I put 25 here. And then if you click on this tab, you get the historical tax rate. I picked 20 because their taxes have dropped due to the Tax Act. There are no preferred dividends. So the earnings in 5 years are 3.255 billion. And then you look at the number of shares, they've been increasing shares outstanding. However, if you again read their annual report, they have a plan to buy back shares. So I put 175. So the trend is actually starting to reverse. They're going to start to use or to buy back shares, which reduces their increases their earnings per share, because you're dividing this by a smaller number. So instead of 180 here, 175. So that gives us $18.56. And then the software calculates an annual growth rate, back calculates based on this number, and it turns out to be 7.1. So if you look at the analyst consensus estimate here, it says 9.7. If you make these judgments, and if they're different from what is shown from what the default is, you'll get obviously a different number. You can look at the sales growth rate, historical again, to help you make a judgment, and the earnings per share growth trend. So they've been growing very aggressively, double digits, very high double digits, and but as you know, a company can't continue to grow at these rates forever. So that's why I picked some lower growth rates. So that's I'm just going to go back to the preferred procedure presentation here. Okay, so the reason that we use preferred procedure is it's easier to guess sales than it is to guess what the earnings growth will be. Sales, if you have, say, a retail operation where they open up new stores, and if you look at their annual report, it's pretty clear how much they make every time what the revenue is for each new store. Like I think Five Below is a good example that we looked at before. You can predict in 5 years based on store openings or what have you, what the sales will be. And using the preferred procedure, if you have a good number for sales, and maybe that's another education topic, is how to predict sales accurately. But the earnings per share follows quite rationally from that. Taxes don't change typically that much. I think this last couple of years is an exception because of the new tax regulations. And a lot of companies, I said, don't have preferred stock. So really looking at sales growth, pre-tax profit, and diluted shares outstanding are the three sort of key metrics when we're doing this calculation. So preferred procedure forces us to think about how the company makes money, how they're running their business with respect to their profitability level, their efficiency, their costs. It increases the confidence in making these projections, and reduces our reliance on using analyst estimates. So you don't just use the estimate blindly without getting a sense of how it came about, or you can use the analyst estimate, but use it to validate some of the assumptions that you make using a preferred procedure. Some guidelines. You shouldn't really have a greater historical growth. Sorry, this is a miss. So if you've been growing at a certain rate, say I don't know, 30% in the past, you wouldn't project a higher growth rate in the future. Okay, and typically you wouldn't project earnings per share growing at faster rate than sales. And typically large companies don't grow more than 15% per year, and then 20% for medium and small. However, for every rule, there's an exception, and here is a good one. Netflix. You can see the historical growth rate for sales is 26%, and it's projected to grow higher at 28. Earnings were historically growing at 12.8% over the past 10 years, but they're projecting 34.5, and that's more than double. So, and Netflix is a large company, so it shouldn't really grow at that rate. So you always have to use judgment. You have to look at these numbers and just try to understand where they're coming from and why they're projecting these things.
There has
So
to be some accounting magic there.
yes. Any questions?
Hey, I had one quick question just about the income statement.
Sure.
So I noticed that the dividends were subtracted when we were calculating earnings per share. Yeah. Typically, I haven't really seen any dividends reducing the net income on regular income statement. I was just wondering why we're doing it this time.
Sure. So these are not sort of common share dividends. These are preferred dividends. So some companies have preferred shares, and other companies have just common shares. They don't have any preferred shares.
Right.
So if a company goes bankrupt, typically if the debt holders, if the company owes money to the bank, so the bank is a debt holder, they get their money first.
Right.
Next in line are the preferred shareholders. Okay, they get their money, and if there's anything left over, common shareholders get it. Right. So the reason that you subtract the preferred dividend is because that number will not come into the earnings per share calculation, right? So that amount is not available to shareholders. So if we didn't subtract it out,
we're basically just netting out the obligation required.
exactly.
Okay. So.
That's a much more elegant way of saying it than I just did. We're netting out the obligation. Yeah.
So then would we include interest as well then, since that would also have to be paid out to debt holders, or are we just not?
No,
Okay.
because it's typically not on the income statement.
Can you go to the next slide?
This one?
Sorry, go ahead.
Next slide.
Next slide.
Why are some of the figures like other expense and income tax expense in brackets, and some of the other figures not? They all look like you're subtracting all of them.
Yeah.
I think so. I think it's because you can other expenses. So it's saying net, and so I'm not sure exactly, but I'm guessing that could be a positive number or zero, and so they're putting it in this case as it's being subtracted from the others. I
think, Penny, what they are doing is just presentation-wise, total operating expenses. So they have this total for expenses. That's why they didn't put the bracket around, because they have this total operating expenses. So it's supposed to be the 1.95 is supposed to be deducted from 5.16. That's just presentation.
Okay.
Well, okay, so I guess it makes it more confusing to me, but okay.
Yes. Yeah, I mean, if they're so you have gross margin, cost of goods sold should be negative. So all of these red boxes really should be negative. But I think as Jane was saying, they're adding this. I would make this in brackets as well.
Right.
Yeah. And it's different. Each company shows it a different way, and I agree with you. It's a bit confusing.
Yeah,
but basically, if you look at anything that's a cost and just subtract it out, you'll get to the right number.
Great. Any question for Haney?
I thank you very much, Haney. I look forward to trying this. I'll probably have questions after I try it, but thanks for a good presentation. They explained it very good. Thank you.
Yes.
Yes, thank you.
Yes.
Thank you.
So if you don't have any more question, we go to our stock study. So Henny, Mina, and I, we cooperated and we did the stock study together, and we selected semiconductor capital equipment industry to look at. And so Mina is going to give us an industry overview and trends, and then Haney will present one of the stock, the lane research, and I will be presenting the integrates. So should we give that to Mina?
Yeah, sure. Here we go.
Okay. I
I
had
will
changed the order of the slides, Jane. So okay, I'll.
I
Just
don't know
one
if
sec,
I
sorry.
have the updated one as well.
Mina with the screen. Mina,
Right. I'm in a Mina presenter.
Okay.
One moment.
Sorry.
I'm on-
The only thing is, Jane, we talked about just doing the lamb one first. You mentioned before, and then the industry. So I changed the order of the slides before the meeting started. So, but we can. So Mina, it's this is the right order right now. So you'll have to go over here to the semiconductor.
Yeah, I'm just trying to get the new file.
Do you have this presentation, or do you want me to?
No, I don't. Not yet. I was looking.
Okay, let me.
The older one. Let me just look at Google
Industry
Trends.
trends. Here we go. Okay, go ahead.
Okay, Henny, I make you a presenter?
Yes, please.
Okay. Sorry about that. I didn't realize I didn't have an updated presentation, but let's just do that. I should have checked again there, but let me see here. Okay, perfect. So yeah, so we selected the semiconductor industry. So this is semiconductor equipment and products are used in the manufacturing of microchips and other electronic uses, so wireless communication, defense equipment, LED projections, automation, kind of any heavy-duty software, any hardware that's required for new technologies require semiconductors to be completed. So this industry really came to fruition around the 1960s and 70s. That's when the technology had become commercially viable, and profitability was present. So that's about when it started. There are several big players and several new emerging players, but it is becoming more of a top-heavy industry from what my research shows. Most of the markets are also international. China is the largest and fastest growing market for semiconductor products. So as a result, it's the fourth largest export of the U.S. I believe sales this year are going to be in the realm of 468 billion for industry wide. So it is, which is an increase of about 12% from last year's at this time. And a lot of that growth is credited to AI and blockchain technology. So interestingly, for Bitcoin mining, it's really important to have the servers and the infrastructure to do it on a large scale. It's been a boon to the industry. Now I just want to see my next slide here.
Did you say blockchain? What's that?
Blockchain. So it's the digital currencies. So Bitcoin, for example, would be a type of blockchain technology. So the emergence of that industry or market has increased demand for semiconductors. I've lost my presentation, unfortunately. Just give me one moment, please.
Henny is showing in case if this is what you're looking for.
Oh yeah, so this is just a table of the 10 largest companies in the industry at the moment. So you'll see some familiar faces like Samsung, Texas Instrument, NVIDIA, Intel, and you'll see there the growth in revenue from 2016 to 2017. Some of these companies have some significant growth, like Samsung in the industry. They've brought a lot of that production in-house and integrated their productions. And Intel and other these companies do significant amounts of exporting. Let's go to the next slide, please, Hanny. Thank you. So the one issue with this industry is that it's cyclical in nature. It's inherently just the same way as the microchip industry is. Sales and bills of intent and contracts are made on quarterly projections of future sales and demand for that quarter. So depending on the actual sales in that quarter, it'll severely affect the following quarter's supply and demand issues. So the next orders may be significantly lower if sales were less than projected, or they might increase substantially if demand was higher than expected. So there is that problem of quarterly volatility. However, the industry has been growing steadily, kind of in a long-term view. So steady growth, but high quarterly volatility. So if you'll see from the next slide, there's a lot of volatility in the revenue on a year-to-year basis, occasionally quarterly, and so it does come with some risk and some apprehension when investing in this industry. But if we're patient, it looks like there's growth, and analysts do forecast continued growth in the industry. I believe projections for the next 5 years are about 6.8, 6.9% growth industry-wide. And a lot of that is attributable to AI and artificial intelligence. Some analysts have predicted this is a massive boon or an ability for a renaissance in the industry, because there is, they suggest that hardware is actually the moving force for AI at the moment, and that this integration and this ability to really connect machinery with the software is what is driving the push to AI, and so that the market is going to expand as we kind of refine AI technology and really develop it. So some quarters of the industry do have really high projections in terms of their optimism, but it is a diverse market in the sense of it's so multifaceted. What we use semiconductors for, kind of every sort of electronic, wireless communication, computers, consumer devices, so industrial use. So it is a bit wide that way, and I think it was a good place for us to find a safe and defined area of growth. There's always going to be a need for semiconductors, and there is opportunity for growth, but there is some risk as well. Some of the obstacles that we identified with this industry are China is at the moment the largest and fastest growing consumer of semiconductors, and it seems to be there's a centralized push towards development of a domestic industry for that production. So that's a bit of a medium to long-term risk for the industry in the US. So a lot of the companies that we might be investing in, and so that has been a source of concern. The other is the cost of manufacturing and storage of these materials is quite high. It looks like the cost of production has increased by about 20% on a year-to-year basis. And this is a problem, especially in light of the cyclicality of the market, and that there could be large amounts of storage. There might be periods where the equipment and the factory is underutilized, there's undercapacity, so it's just kind of a waste of resources, especially the depreciation on that type of asset and the specialized equipment necessary. So there is some problem associated with the increasing costs for the production and storage. So those are the issues identified, but analysts are still confident that it is an area of growth, and they do project continued sustained growth in the area. And I think that's why we really thought it might be important to invest in this industry. So I think that basically covers it from my end. I think I'll pass it off to Hanny, I believe, at this point.
Yeah, Henny, would you also go over why did we pick up this industry and the stocks?
Yes, I will. Okay, so I'll get back to okay, so how did we find these companies? So we were, the three of us, Jane and Mina and I were slated to do the stock study this month. We did a value line screen on September 24th. And the screen was looking at companies with a financial strength greater than B++, cash flow 5-year growth of over 10%, because we wanted companies with strong cash generation potential, and good profit margin greater than 15%. And we look at the low return, the projected low return. So value line gives a low stock price and a high stock price forecast 5 years out. So we were looking at the low return being a minimum of 10%, because we're trying to get to a 15% return on our investments, or 5% above the current market average, which is about 9 or 10%. So that screen resulted in the tickers that you see below. IVZ, which is an asset management financial services company, 2 oil and gas limited partnerships, 2 healthcare companies, Celgene and UTHR. I'm not sure what that one is. I think it's United Health or something. And then AMAD and Lam Research, which are in the semiconductor and technology space. So we looked at the SSG, and for each of those, and we decided that we would, based on the visual analysis, Lam Research looked fairly good to study. So then Jane identified ENTG. Was it Intergress? I think Intergress, and as a competitor to study. And it's not an identical competitor, but it's difficult to find exact competitors, because these companies make equipment that makes chips, as Mina was saying. So they're kind of secondary, and they each specialize in different types of equipment. You'll see a little bit later, the process for making chips, and it's quite complicated, and there are a lot of steps to it. And so each company has a sort of a niche of the equipment, and so it's difficult to find direct competitors. So I'm going to talk a little bit about Lam. This is a picture of a machine that manufactures microchips, and it's in one of the steps. But what's driving all of this growth in this industry? And well, there's a number of different sort of drivers. First of all, more and more people are connected, through social media, through smartphones. Everyone is moving to the cloud, whether it's business or personal, to store their information. Computers are becoming faster and faster and require a lot more memory to run. And there's a demand for all of these things, but at a lower cost. And so manufacturing chips, microchips at lower cost is creating more demand, because the end products are cheaper, and more people are buying them. They're more affordable. But all of these things that you see here they have one thing in common, and that's microchips. And that's what Lam and all of these companies do. They make the machines that make the microchips. But here's Mina talked about future growth, and we can all relate to some of these things. You've got smart homes now are becoming very commonplace. Industries are using more robots. A lot of people all over the world are now, own a mobile phone, a smartphone. Even in a lot of third world countries where they can't invest in infrastructure to put landlines, everyone has a mobile phone, because it's it's cheap to get one these days. Autonomous cars. Just a couple of weeks ago, I had the opportunity to test drive a Tesla Model 3, and I didn't, it was very nice, and I went for a drive on the highway and so on, and then we got back to the dealer lot, and the gentleman that was taking me on the test drive said, "I'd like you to park the car between these two cars," and there was one parking space between two vehicles. He said, "I want you to press the park button, take your foot off the accelerator, and take your hands off the steering wheel." And I kind of looked at him funny, and but I did what he said, and lo and behold, the car backed itself without me doing anything into a parking spot. And so, that's just a very simple example of automation, autonomous vehicles, and where we're heading as a society. The other one is healthcare, and there are a lot of people around the world that don't have access to physicians and healthcare practitioners, and through the internet, through all sorts of technology, they're now able to do that. Robots are another big data generating segment. I recently saw a presentation where a robot had a human kind of screen face, something that you'd see on some sci-fi movie, and it had a camera, and there was a person standing in front of the robot performing different tasks, and one of the tasks was folding a shirt, and they kept folding the shirt over and over again, and finally the robot, I guess, was looking through the camera at this operation and started to fold a shirt exactly as the human was doing it. So that's all AI, artificial intelligence, and it's all very sophisticated software, but all of these things require microchips. And so even though there's cyclicality in this market, I think if you look at all of these different segments, we're moving very fast towards a different kind of society. And this graphic talks about data and how we are moving along this curve. So initially we had mainframe computing. I remember when I was in university, mainframes would take up half a building. Today you have probably more power in a smartphone than some of the mainframes had. Then we moved into PCs and desktop computers and so on. Now we're getting into the internet. There's a lot of internet traffic, and cloud computing and so on. But we're starting to get into this inflection point where AI is becoming much more prevalent. And so as that happens, a lot of data is going to be generated. That data requires memory, and it requires high-speed computing power, and both those things require chips. And they're predicting that in the near future that we'll be generating what's called zettabytes of data. And don't ask me what a zettabyte is, but it's a very, very large number. So here's a simple example. This is a picture of the Library of Congress, and it's it's estimated that there are 20 million books in the Library of Congress. I was in London, England recently with work, and I went to the British Library, and they told me that they have 5 more books than the Library of Congress, and they're the biggest library in the world. But that's regardless. If you take these 20 million books and you take all the text, uncondensed text, and you multiply that by 100,000, that's equal to 1 exabyte of data. And so looking at this graph here, we're in this part of the graph, we're dealing with exabytes on the internet. So last year, or 2016, we had approximately 1,100 exabytes of data that was exchanged on the internet. And if you want like a mathematical representation, an exabyte is 10 to the 18. So my mind can't go up that high, but it gives you a sense of how much information we're starting to generate. And when you go back to this slide and you add all of these things up, that's a huge amount of data. So I think we're going to see an incredible acceleration in chips and manufacturing. People have looked at, okay, what how do we make these machines smarter? How do they work more efficiently? And they work. Artificial intelligence works on data. The more data that you give an AI engine, the more accurate it will become. And so as the data volume increases, the accuracy increases, and as the computing power increases, the same thing, the analysis accuracy increases. I recently read an article about a law firm in the United Kingdom, and they do a lot of mergers and acquisitions, and they hired their first AI lawyer. And this AI lawyer, basically a machine, was given a contract to review and came up with pretty much the same kind of comments that a human lawyer would identify. So it's kind of exciting and scary at the same time. A lot of medical professionals now are being replaced by computers, and all of this requires memory, and it requires fast computing power. So this is just, I won't go into this in a lot of detail, but this is a schematic of all the steps that are required to make chips. And each of these steps, and some of them are, like you can see here, it says 20 to 30 processing steps, so they put that all in one box. But each of these steps requires a lot of machines, or one or more, and these are very sophisticated, very expensive machines. And the two companies that we're presenting today, they don't make the chips, but they make the machines that make the chips, and they make memory. So that's what we're going to talk about. This is one of the machines that Lam Research makes. Here's some of their customers: IBM, Intel, Micron, Toshiba, Samsung, some of the biggest manufacturers in the world, chip manufacturers. This slide is just showing their market share. So Applied Materials has the highest market share, and then Lam in the equipment space. Tokyo Electron is another big player in the industry, and but you could see that between Tokyo Electron, which grew 56% in 1 year, and Lam 50%, those two are kind of neck and neck, and they're pretty staunch competitors. Tokyo Electron is not traded on North American markets, and that's why we didn't look at it. So what's Lam's business strategy? How are they going to grow in the future, given some of this competition and so on, some of the challenges that Mina mentioned? Well, the market is characterized by rapid innovation. They have to keep inventing better and faster machines, more efficient machines to make these chips. So Lam spends a lot of money on R&D. And you can see here, they're in between 2016 and 18, they went from 900 million to 1.2 billion. So about 9 to 10% per year on growth in R&D. That R&D is very targeted, and like I said, there's a lot of machines in making a chip. So they pick certain areas like deposition, etch, clean. These are niche areas that they have a competitive advantage over some of their rivals, and that's why they're profitable, and that's why they continue to grow. They also, once you sell these machines, you have to service them. You try to build long-term relationships with the customers, make sure that you're not just servicing, but you're listening to their suggestions, how you can improve these machines and so on. Because once they use your machine, it's very difficult to to go to a competitor. These machines cost millions of dollars. So once you standardize on a particular machine, it's difficult to switch. So LAM really focuses on service and developing long-term relationships so that they don't lose their customers, and they can sell them more products in the future. They're very diversified. A significant amount, over I think 80 or 90% of their revenue comes outside of the United States. And you can see here, Korea is Samsung Electronics is one of their biggest customers. Japan, China, Taiwan. So the US is relatively small compared to some of these others. That's both a blessing and a curse. So because of tariffs, trade barriers, trade disputes, and so on, that's a risk. Foreign exchange fluctuations, currency devaluation by certain countries, and so on is another one. Managing staff and foreign operations is not always easy. And then compliance with export controls and laws and regulations. And sometimes, a country, or the US will, we just went through this in Canada. We had the free trade agreement, and there was a lot of debate over it and so on, and we finally came to a resolution. And then we found out later on that we can't sell certain things to China because of some of the clauses that were negotiated in the free trade agreement. So as a sovereign country, we are still restricted because of our agreement with Mexico and the US. And so you get some of these export control issues that play out, and that's a risk. And then, of course, economic and political conditions change, and that's also a risk. So that's something to keep in mind, because it's not, there's tremendous growth, but there's also some risks in this market. This is the SSG. I went through this, so I'm not gonna go through it in any detail. You can see that the visual analysis, both earnings per share and sales are growing fairly steadily. And then if you look at the management section here, pre-tax profit, return on equity, debt to capital are all green and pretty positive. So now what I did, just kind of going back to the comment I made about analyst consensus estimates, I took all of the annual, this is earnings per share annual growth rate that I could find. So every year, SSG, you can see 9.7 for the long-term year estimate of years. Zacks, Value Leaders, Yahoo, etc. And I did a calculation. I said, okay, if I grow, so if you look at 2018, sales growth rate of 7.1 per share is 13. And and then I used the close was yesterday or day before, it was 42, and I just took 20, but it could the low price, and then I just did this using the, so I based on this 13 point and 5 the future share value be. You can see there's quite a bunch here. IBES, the low value was 24 and the high was $19 per share, which gives you a range of a high price between 336 and 406, and these are the high prices based on this. And this is the upside downside ratio for each of these. Okay, and what I did was I used so the median of all these numbers here and the average, which are pretty close. It's not much difference, but you can see that you need to apply some judgment, because you can project a high price around $200 or $500 at the high end. And so it's good to be conservative, but at the same time, we're looking at a upside downside ratio that's still pretty much within the bar for most of these. Morningstar for some is a very low earnings per share growth rate. This was just a bit of a sensitivity analysis to see where we could end up. And what I did was I used the preferred procedure at 7.1% safe, and using dollars and as a future earnings per share, and the forecast price, 78 side downside of 5.4 zone. This was just from Manifest Investing. They're projecting 24%. I won't go through this. This is big charts just showing the average PE. So in summary, the company is pretty strong. They have a historically solid revenue and earnings. They make a lot of products that are seeing a growth in demand due to this AI growth that we've talked about. Right now, they're undervalued, and I think if eliminating cyclicality and sort of looking at the long term, it's a good opportunity to buy this company. So that's my presentation.
Henny, do you
Yes.
mind you show the SSG, how you come up with 5.4 upside and downside ratio?
Sure.
Why?
Okay, so here's the preferred procedure. Oops, and the current PE ratio is 10.4. This is based on today's, I think. So the price today was 137.62, and so I used a PE of 14, and the average PE over the last 5 years or so, but as you saw in the big charts, it's around 15 something, so it's 15.6. I used 14, which is conservative, and so 14 PE ratio times $18.56 a share gives us a forecast high price of $260 roughly. And then for a low price, I used the closing minus 20%. I said if it goes down, and if you these are all the different options for low price, but I used closing minus 20%, so it gives us 115. And so it's a 5.4 to 1 upside downside ratio, and total return using the high PE is 14.8, using average PE 13.4%. So I think this analysis is pretty conservative. If we wanted to bump this PE up, or if this number 115 is pretty low, given that the low this year is 135 and it's sitting at 137, it would be hard to imagine that it would drop down that much. So we could bump that up. That'll change the upside downside ratio, but I think based on some of the analyst consensus estimates, this it's a fairly conservative SSG.
Henny, I have a question. Currently, you have average low PE 12.2, and the current PE ratio is 10.4.
Yes.
Do you think we should lower the average lower PE ratio?
Well, I didn't use it. So I used. You could do this calculation using that, but I just said, could this stock drop another 20% from the current price, and that'll definitely change the low PE. So I just chose that as my low price. I didn't do a low PE calculation.
Okay, thank you. Any question?
I mean, if you look at if you use the average here, the low PE, if I put 10 in here, I'm not sure what that. Let's. Is that right? If I use a low average low PE at the current price, or sorry, at the current earnings per share of 13.2, it gives us a 132 stock price, and that gives you a 21.7 to 1, which is, it's
That's all right.
yeah, that's very high. So that's why I use this number, the 114.
So I was reading or I heard, I can't, if I heard it on the television or read it, I can't remember now, but that most computer components, including most chips, are more and more being made in Asia. Now, where is this company made? Where is this company located, Land Research?
So they don't make chips, they make machines that make chips.
Oh, okay. Yeah.
But you're absolutely right. Like if you look at the chart, okay, where is it? So a lot of these guys, with the exception of a couple of them, like Intel and Micron and so on, are in Asia, and the competitors to Lam are also, there's quite a few, like Tokyo Electron and Hitachi and so on. They're in Asia as well. So you're right, Bernard. But these Lam is in the U.S. and a lot of that I think has to do with innovation and patents, and so they're constantly developing new patents, and they're very protective of that. So the machines are made in North America, but the chips are made elsewhere.
Oh, thank you very much, Haney.
You're welcome.
Now, this stock looks like it's selling at a 52-week low.
Right.
And I was just wondering, if you've got any, and the other stocks in the industry seem to be on a big downtrend also. Is there something happening in the industry where the market is so negative on them?
Yeah, so Mina mentioned this kind of briefly, but so there was a huge demand for chips within the last couple of years, and whenever there's a demand, they oversupply the market, and so a lot of analysts are thinking that for the next couple of years there won't be a huge demand for the machines that Lam and others make, because there's already an oversupply of these chips. But and that's I'm sure that's that's the case. But I also think that this whole area of AI is developing so rapidly, and there's a lot of research going on into how to make these machines more intelligent and so on, that there's a lot of competition going on. And the way that you do that is to improve the performance of the chips, make them more dense, etc. And so I think that we're kind of at a point where you're likely to see, because of innovation and rapid change, that the demand for better and better chips is gonna continue. So I think in the short term there's a downturn, and a lot of these companies are selling at a discount. Long term, I think there's huge upside.
Okay, thank you.
Any question?
I was just reading that Lam Research is based in Fremont, California, in the Silicon Valley. As of 2018, it was the second largest manufacturer in the Bay Area after Tesla. I thought that's interesting.
Yes. Okay, if no question, should we go to
Everything good happens in California.
Hey, you should move to
VICS,
California, Henny.
VICS, Lam Research. I need to move to California.
Yes, that's exactly right, Henny.
Weather,
Yeah, and
weather.
We have
investment
a
club?
nice weather, you know, if we're
Yes.
not selling anything else, just the weather, Henny.
Just the weather. So, Haley, can you change to me as a presenter?
Definitely, absolutely. How much time will you spend on your first slide? Because I really need to get some water.
Oh, yeah.
Okay, Jane,
No,
I'll
you
make
don't
you
need
presenter.
because
I'll
I
make
will
you
do the
presenter.
screen as well.
Okay,
Okay.
I'll make you a presenter. I just did. Go ahead,
Yeah.
Henny. You do need a water. Thank you for all
Yeah,
your
yeah.
presentation.
Have
You're
some
running the
water.
show tonight.
Yeah, I talk a lot. So I will be doing the. Can you see my screen?
Yes. If you can make a little bigger. Or is
Yes.
I need to make it bigger.
Well, I will do the screen.
Okay. You just make presenting view or something.
Yeah.
Okay.
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 Okay. I picked ENTG just because it's a quality company and it's in the same industry because I think land is a good company to look at, but for the reason that Haney mentioned about the potential oversupply of chips and the less spending on the semiconductor equipment, and I think it's good to look at another type of company in the same industry. So ENTG, Entegris, is a leading provider of yield-enhancing materials and solutions for advanced manufacturing processes in the semiconductor and other high-technology industries. It is headquartered in Massachusetts with a global infrastructure of manufacture service centers and research facilities in different countries, including US, Malaysia, Singapore, Taiwan. Oops, sorry, get that. And also Taiwan, China, South Korea, Japan. And basically it has 3 segments, which we'll go over more closely. ENTG has many patents because it has invested a lot in R&D and continue to do so, and has been introducing new products and capacities. Value line shows companies' financial strength, which is pretty good, B++. Of course, that's our criteria to search. And also price growth persistence is really high at 95. So for 201A particularly, the management looks for organic sales growth of about 10%. In addition to this growth, organic growth, ENTG has been seeking to acquire quality companies. Over about 4.5 years, like for example in 2014, April, they acquired ATMI. It's an advanced materials and material delivery systems company. Also in 2017 and 2018, they acquired another 2 tiny companies. And another big company they acquired in 2018 is SAS Pure Gas, deal with bulk gas purification. So it's another high technology industry they are working with, besides semiconductor. So SAS, the SPG, they acquired just this June. They have paid $355 million in cash, but at the same time, the company is expected to contribute to second half of this year a very handsome EPS of at least 0.08 to 0.1. So as Henny and Nina mentioned, chip innovation is the way to go in the future, because we require more computing, we require better computing speed, we require more data memory. So all the chip manufacturers are seeking to make better chips, but making better chip is no longer just about increasing speed. Also, it's all about finding the new material to build higher performance chips, higher performing chips. So material innovation is the key driver for the future. Oops, can you see?
No.
I don't know what happened. Let me try. Sorry about this. Let me pull out again. Oh, I don't know what happened to my slides. Okay.
Oh, there you go. Mhm.
No, I don't know what happened to my slides. Do you think?
Does Hanny have a copy of your slides?
Henny?
I was just looking at our Google Drive, see if they uploaded. Did you
We
upload one to Google Drive?
We did.
Okay.
We did.
Okay,
Sorry about that.
it's okay. Let's see. Interpret. You have a PDF?
No, I think
No, you didn't. Okay, let me see the.
no, I think I got it. It's
Okay.
here. Can you see properly?
Yes.
Okay.
Okay.
As we mentioned, innovation in material is the key driver of the new approach, but only if the chemical industry can address a lot of challenges, including precision, purity, and integrity and safety in delivering the materials. So there's a greater need for more precision materials, because the process of making the chips, as Henny mentioned earlier, is more complex. So they need better chips. They need more precision materials to make the chips. So to make the chips better, we need better materials, and we have to make sure the materials are pure. The solution we use and the materials we use to make the chips are pure. So the purity means money. So that means if the company require, a lot of customers of ENTG require contamination control, and if they can increase their yield by 1%, that means the annual profit they increase will be by 150 million for leading edge fabs, logic fabs, and for the memory chips, the annual profit will increase by 110 million. So they need to control the contamination across all the entire supply chain, and the earlier the better. So ENTG is the company that is doing that for their clients. And ENTG has a lot of solutions. It has a broad portfolio of solutions. And as I mentioned, it has 3 segments, and it's uniquely positioned to address all these challenges they are looking at. And specialty chemical and engineered materials, basically creating advanced materials with better electrical and structural properties. It has a global infrastructural research and technology centers and manufacturing capability close to the customers. The second segment is the micro-contamination control. It delivers ultra pure solutions to improve chip performance and also increase the reliability and save costs. The third division is advanced materials handling. So to have all these pure materials and solutions, you need to make sure it's delivered and packaged and delivered properly and all through the supply chain to arrive at the client's factories. So it protects critical materials throughout the supply chain. So ENTG, over the 5 years time, if you look at the chart, the revenue has gradually increased by a rate, a CAGR rate of 18% over these 5 years. And if you look at later, if you look at SSG Live, then it's 16.4. I don't know why the discrepancy, but basically it's growing. The top line is growing at 18%, 16 to 18% over the last 5 years. Also, the profits have been growing faster than the revenue. And if you look at the here, the EPS, actually this is non-GAAP EPS. Later you will see the GAAP is slightly lower, but then the non-GAAP has been adjusted for tax, the impacts from the tax act, and also for some transaction costs for the merger acquisition deals, because these are all non-recurring. So if you look at 1.44 at 2017, then 2013 they have 0.58 only. So over these 6 years, the EPS have been growing at 26%. But if you look at SSG later, then I don't know why historical EPS growth rate for over these 5 years is 50%. I cannot figure out why the discrepancy, but this is a very high rate, high double digit, you know. And so if we just look at later, I will show you online the SSG, but I just want to show you that this is what has been shown on SSG, the first page. And the pre-tax profit over 5 years is like over 200%. Of course, we don't expect that to continue at such a high rate, but then I think our estimate is quite prudent, and later we will look at in more detail. So, of course, the past cannot predict the future completely. However, it's a good indicator. So the last quarter 2 this year, ENTG continued to deliver outstanding performance. The sales is growing at 16% from past year, even though from the first quarter is 4%, but still steady growth. And the growth rate, the growth is across all divisions, which is very important, as you can see. And the GAAP EPS is 0.38 for the second quarter. It has increased by 36% from past year. And the non-GAAP has increased by 44% from past year. And if you look at just from the last quarter, it has increased, basically flat or slightly decreased 5%, but the non-GAAP has increased by 4%. from last quarter. So earning per share, here, this slide shows the GAAP and the non-GAAP earning per share comparing the 2018 and 2017 and compare the second quarter with the first quarter. So as you can see, it's been growing steadily and continuously. This is the gap that I'm showing you here, the 0.38 for the second quarter earning per share. And this is the non-GAAP. After adjustment is 0.49. And as you can see, the guidance, it far exceeds the guidance by 0.02 per share, which is really a great performance. And if you compare half year in this year with half year last year, it has increased by 52, almost 53% in earning per share. So up to date, the non-GAAP, so just now is the GAAP, now is the non-GAAP. So again, it's like 52 to 53%. So the outlook from the management, the third quarter, is continually growing at a rate of 16%. So the guidance is falling, in this range, 395 to 410. The operating expenses and the earning per share is between 0.36 to 0.41. So it's still very, very attainable because they actually achieved 0.38 in second quarter. So non-GAAP again is even better, as you can see from the slide. So ENTG is a quality company from what we just presented, and the value line I extracted some important contents over the years till 2023. Over this period, the earning per share, the value line is predicting or forecasting 20%. So we will look at our SSG. I use 30.8%. And as you can see from the earning per share, projected earning per share for 2019, it's gonna achieve 2.25. And this year they are predicting to achieving 1.95, which is consistent with the management forecast guidance. So this stock is now at a very reasonable price, and it has been affected for the reason that Henny mentioned, because of the potential oversupply of chip and the less spending in the chip equipment, manufacturing equipment. But then again, this stock is not about chips. I mean, it's about chips, but it's not about the equipment or making chips. It's about material to make the chip better. So this stock carries our highest rank, value line highest rank for year ahead. And it's when the report was issued in December, late December, the price at the time was 29.5, and now as of today, the price is 26. So with all these outstanding performance and a even lower price, I think this is a good time to establish a position in Integris, ENTG. So when I prepared SSG, perhaps I can go to SSG just to show you online how. Can you see this properly? Yes? Hello? Hello?
I can see that. Thank you.
Sorry, I'm muted. Yeah, if we can make it a little bigger.
Okay. How do I make it bigger?
Oh, you just say Command plus or Control plus. Sorry, you're using Mac. Just Control plus.
Control plus. Command Control plus.
Control. Oh wait, Function plus. Wait, which one? Let me see. The Mac. Hold on.
Okay. Anyway, as I
Yeah, come
mentioned,
in plus.
percent, because I don't know how to achieve EPS at the reasonable price, so I just use 13%. So which is based on this forecast is about 13%, and I use the pre-tax margin ratio of 19%, which is reasonable if you look at the current two quarters. And this is also corresponding with the management forecast. And then we have a tax of 20%, which is prudent, even more than prudent. And then that get you to the earning per share forecast of 13.8%. As you remember earlier, the value line forecast is 20%. Of course, we don't solely rely on value line. We also look at a lot of factors. I especially focus on management forecast and look at the market trend and the management representation, and listen to the conference call and presentation of the management before I selected the stock. So if you look at the second page, with that 13.8% in earning per share growth, I take out the outliner in 2014 because, as you remember, in 2014 they acquire a big company, and there are a lot of transaction costs and integration costs related to this. So if we make all the adjustments for non-GAAP, that will come to the regular number. But this, since it's in the system, so I just deleted 2014 numbers. So I take high PE, average high PE of 23.4. How do I divide that? I take 26, the average, divided by, multiplied by 90%. So I get 23.4. And then I get the average, the forecast high price of $66. And I use average low PE of 13. How do I get that? I used 14.6. Even though the average low PE is 16, almost 17, but I choose to use 14.6 and then multiply it by 90%. So that lead to 13. So with that, I think we are being very conservative, and I get this forecast low price of 15.7. Again, you can notice that the estimated low earnings per share, I have made adjustments for the tax impacts from the Tax Act, so that give us 1.21 instead of the lower number that we looked at earlier. But if you remember, I mentioned earlier, the non-GAAP EPS, in fact, is 1.44. So I'm being very conservative by using 1.21. And even with these conservative numbers, we get to the upside and downside ratio of 3.7. So let's go back to my presentation. So when I prepare, any questions so far with about the SHG or the background, anything so far? Any question? No? Should I continue? Okay.
Yes.
So when I prepare SHG for ENTG, I only make adjustments, as I mentioned, for the Tax Act. So the upside downside is 3.7. But if we use the 1.44 as the management represented as a non-GAAP EPS, then the upside and downside ratio will have been 5.2. So I recommend to buy shares of ENTG for the following reasons. Firstly, it's a defensive. It has a defensive business mix. It has been weathering the current capitalization correction better than its other semi-cap equipment peers, because most of its revenue is about unit. It's not about cap. So it has a very defensive business mix, and also it's been helping it has been innovating and making better materials, innovative materials to enable better making of better chips. So the semiconductor company can continue to improve their chip performance by using ENTG's materials and solutions. So it also growing. It's growing. The industry trend is it's growing purity. Purity is a must, because if you want to make good good quality chips, you need to make sure the whole process is controlled. There's no contamination. So purity is the money, and so the purity requirement will drive the client to adopt more purification devices, as well as will lead to higher replacement rates. And thirdly, as we showed earlier, in addition to the organic growth rate of 10% per year, ENTG has been seeking out to acquire quality company. So in the past 4 years, only the past year and a half, it has completed 4 transactions, and it's looking out for more potential to purchase in the future. So ENTG has a track record of creating value through strategic acquisition, and we're looking forward to see more company to be acquired by ENTG. And I think this is a great company at a great price. The current price as of today is 26.32. Any questions so far?
I'm just curious about things. So we have Lam Research, we have this company, and we also have a Skyworks. They all sound sort of related to chips, right? Semiconductor. I just want to make sure I understand. So Lam Research is about making chips machine, right? Make some equipment to make chips.
Yes.
So Integris, this company is to provide
materials
to make the chips.
Yeah.
So Skyworks is what? Skyworks is the final product, is the chips? Because we own Skyworks, right? Because they are in the semiconductor area.
Did you present Skyworks? I
didn't. Well, I presented a while back. I just remember it's also something to do with chips that used with smart Internet of Things, mobile devices. I'm just trying to understand the differentiation among these 3 companies.
Right, yes. Skyworks does make chips, mostly for, I think, communications like cell phones and things like that.
Right.
So they would use the equipment from Lam possibly, and the materials possibly from this Integris.
Okay.
They would be customers of these companies.
Right. Okay. So can I take a look? What's the size of Lam Research versus this company, Integris? Are they small, medium? What size of the company? Because I don't remember the sales number.
I can show you the.
Oh, okay. So I have it. So Integris is a small company, only 1.3 million.
Yeah.
What about Lam Research? I don't remember. Is it a small size company?
Oh, I'm sure they're huge.
They're about 11 billion or so, 12 billion.
Oh, okay. So 11 billion. Yeah, 11 billion. So otherwise 1 billion versus this was 11. Okay. I see. I just want to understand. Okay.
Yeah.
They are doing different things. Another thing for Integris, Jane, for your SSG, I'm just curious, why do you multiple 90%, take 10% off?
Just to be conservative, just to show that as conservative as we can, then what result do we get?
So why don't you just take the average, or do you because I remember for Henny's, he
The
chose
reason I
average
use
PE, right? Uh-huh.
average P, but I also, when I look at average P, I also look at the trend. So if I know the current or the past, very recent past ratio is lower than the average, then I would elect to use the lower PE.
But
That's
Nami,
why
I'm talking about the high PE. So you
the
chose
high PE
23.
also just the 90% of 26. Just to be conservative, there's no black and white rule for this. Yeah.
Right, I know. I'm just curious that what if you chose even lower?
Yeah. If I use the average, definitely will bump up the ratio, the upside and downside ratio to like at least 4 to 5%, 4 to 5.
Hmm.
Yeah. So that's why I'm showing you the least, the most conservative number we use. Then we still get buy recommendation from SSG. And also, when I look at this, I use 1.21 because I didn't make all the adjustments. But if we use the non-GAAP 1.44, then this will bump up to 5.4 upside and downside ratio.
Okay.
Even with all these low PE ratio we are using for high and low.
Okay. So
it looks like Jane and Haney have both done excellent studies. When they work together and talk together, how would they prioritize these two companies, and which one would they think is the best buy for us?
yeah, what do you guys recommend?
I would say both, given that we have a lot of cash. We've got $5,000, and then remember that after today, I'll be putting in another 1,000, so 6,000. So both of these are undervalued, and I would have no hesitation at picking both.
So could we buy maybe 2,000 of each?
Probably not, because we just want to be conservative. I don't know. It's up to you to motion.
Well, I would move that we do that.
Yeah.
Okay. All right. So
I would think that would really put us in, like, because we also have Skyworks, so we would be very heavily weighted in a particular sector. So we might want to look at maybe some other sectors, but if we bought 1,000 of each, that might not be that bad.
Okay, I would move that. That's fine.
okay.
Anything, Shay, you want to say?
I want to say wait, time to vote.
Yeah, we do. We go to the email.
Yes. So do we have a motion? Anyone wants to make a motion? Oh, I guess we already have motion. Did Penny you already made a motion?
I'll second the motion.
Oh, okay, second the motion.
So we buy $1,000 of lamb and a ingress, right? Is that a motion? Was that the motion? Okay.
That was the motion. So we go to the email for the vote down.
Do we have any discussion at this point, or?
Yeah, any discussion?
I'm still concerned. I mean, like, this is just play money, but I'm concerned. I mean, what is other than just the supposition that there's a rosy future for this industry? Is there some catalyst or something that's going to turn it around? Because all these stocks the share price has just continually marched down over the last maybe 3 to 6 months.
Well, I think that's a valid concern, but I think at the same time, that's the opportunity to be looking at buying when the stock price is low. And I think we've had a very long bull market in general. A lot of companies are now taking a bit of a hit, And so looking at ones that have good value and are trading at a discount would be, I think, in my view, that would be a conservative approach, is to buy these companies that are undervalued but have good potential. Now, I think the concern is how fast will they turn around, and that's a that's a difficult question to answer. It could be a year or two, maybe. But they both, I think, I don't know about Integris, but I know Lamb has they pay a dividend, and a small dividend, I think, was 1 point something percent, 1.7. So that's some comfort.
Okay, thank you.
ENTG also pay a small dividend. At the price value, at the price today is more than 1%. Okay, so should we go to vote?
So what are we voting on? Are we voting on both, or one at a time, or how's that work?
I think the motion was by both, and by Bernard, and I seconded that.
Okay.
And maybe it's because I don't have my computer. I couldn't get the ballot to work for me. So if you want to manually put me in as 2 yeses, or a yes for the motion, I'd appreciate it.
Yeah. Jay, can you send that ballot again, or is it sent by
Join. She sent
Joy?
it this morning.
Yeah. Okay, I will take a look, Joy.
Great work, Bernard. You did it.
Okay.
Thanks, Roy. Thanks, Roy. Thank you. And Jane, thanks for giving me a link to I could look at these studies. Thank you very much.
Welcome. All right, so should we vote?
Yes, we did. We have okay.
How is it going, Jay?
Right now, I'm only receiving 4, including Roy's. I'm still waiting for the remaining folks.
Okay.
Did you get my vote? I sent it
Yes,
in.
I did, Bernard. I just said, great work. I saw yours. Yes.
Thank you.
Got everybody's vote?
No, I didn't. Jane, I did not get yours.
Oh, I did earlier.
Okay.
One more time. One more time. Did you get it?
Hold on. Let me check the responses. No. Oh yeah. I have Mina, Tom, Megumi. I don't have you and Henny. Andrew has to leave early.
I sent mine, Jay.
Yeah.
You did? Okay, let me refresh again.
Yeah. And also, did Matthew say?
Matt, yeah, Matt couldn't make it, but in his email, he said that he is against the Facebook law. If we are going to buy more, he's waiting to sell Facebook, but he didn't say anything. He
said not to buy anything. He said.
So he said not buy anything. Okay. Yeah. So I don't know why I'm still not getting. I'm not getting Henny and James. I'm just.
So I voted yes.
Okay.
Yes, I did too.
Oh, I got a Jane. Yes, I don't have a Henny. I have Roy. I have. That's weird. Even including myself, I voted.
It's probably having trouble crossing the border.
Yeah,
must be.
Better check.
Okay, so but majority vote is already a vote yes, so the motion passed.
Okay.
Captured
Great.
by ICE.
Yes. So,
Hey, did you pay your duty?
Maybe not. Maybe not.
The border patrol
Oh,
apprehended the
okay.
votes.
I see. Okay, so we have a motion passed to purchase both company, LRCX and ENTG. Are we going to purchase at the price tomorrow, or are we going to do a similar approach as 10 cent?
I think we're fine with open price.
Okay, all right.
Just buy it at the open.
Okay,
Yeah.
so we have Haney to execute that for us. So, shall we move on to next on the agenda?
Yeah.
So this month we don't have any annual or quarterly report to present, but next month, as usual, we have a lot of companies to look at next month. So all this is listed on the agenda. And any other business you would like
We need
to
to
go over?
figure out
Yes.
who's going to following these two new companies.
Oh, yes.
I'm looking at the list. Everybody is following one at least. And also, who's following FleetCore Technology? Because it was John, but John left. It was Tom,
that
and
was
Tom gave
John.
Yeah, and
Yeah.
then who's following now? Tom, can we get back to you on this one or no? Oh, Tom's already followed this company for 2 years. Actually, we're looking for a new person to follow. You know what? I can follow FleetCore.
Okay.
Doesn't
Okay.
Matt have? It says Matt. Does that say Matt FleetCore?
Is it Matt FleetCore?
FLT?
Yes,
Yeah.
FLT. Is Matt?
It
Oh,
says
actually,
Matt.
okay. So this spreadsheet's updated. I'm looking at a schedule. I would just okay.
Yeah. Matt is doing FleetCore. So who is going to do LRCX and ENTG? Because both Penny and I cannot do it.
I'll do Lamb.
Okay.
Ask Joanne.
Okay. Or any other? Okay. Then we will check with Joanne. And should we, any other business we should discuss besides before we ask our guests for comments?
I think we should move on to the guests because we passed the 12 minutes already.
Great. Okay. Sorry about the time. And can I see the guest list?
Yes, it's on okay.
Can we have Aku? Is it open mic for Aku?
Yes, I just opened for her.
Okay. Hi, Aku. Hi. How does it like on me?
It is a term that we've heard a lot because we've seen it happen a lot, but this is one of the most blatant cases of busting someone for shopping while black. Happened to hip-hop legend Cool G Rap. He was in a sneaker store, Finish Line, in Pennsylvania, and they accused him, or at least the people in the store thought he was there. And he was there. He was not actually there at all. They didn't find that out. It's so absurd. Black guy in his 40s.
I think we're talking to different things. Maybe that was on the TV? Aku.
Getting his.
Well, another. I think he is. Oh, he is talking. Oh, he muted himself. So anyway, guests, if you somehow doesn't have a microphone, you can also type your comments or questions under the questions area, and you can just type and then let us know. I'm going to open the second person, Jane.
Thank you, Jane.
Ostraberto?
Yeah. Hello. Hello, Ostraberto.
Oh, hi.
Hi.
Can you hear me?
Yes. Clear, loud.
Okay, that's good. I'm sorry, I missed it. Was that a question, or you're asking me whether I have a question?
Oh, we just ask you for comments. What do you think
Comments.
about meetings?
Oh.
Or if you have any questions?
Yeah.
This is the first time I ever, attend one of these meetings. I recently joined the Model Club. This will be probably my second meeting there.
Okay.
So it was interesting to see, the dynamics on this one.
All right.
Where
Okay.
did you attend the model club? Which club did you join?
Oh, right here in Sacramento.
Oh, Sacramento, yes. Okay, in-person model club.
Yes, that's correct.
Okay, I see.
So
Great.
I really don't have much experience with selecting stock. So I'm just kind of watching, learning, watching some of the posted the webcasts
Yes.
that are posted on the Better Investment group. I'm sorry,
Right.
the website.
Yes.
Yeah.
So yeah, just trying to learn the ropes.
Right.
Okay.
That's
Thank
how
you.
it always started like that.
Yeah. Exactly.
Yeah. Welcome.
Thank you. Bert.
Thank you.
Welcome. Yeah. So should we open mic for Danette?
Yes.
Hello, Danette.
Hi.
Hi.
This will be my second meeting with you guys. I missed last month. Very interesting. I am learning so much. I thank you very much for letting me join your group, your agenda tonight.
Oh, of course. Yeah.
Yes.
Welcome. Yeah.
Thank you for joining us. Any question you may have?
I have a whole bunch of questions, but I think it's just because I'm learning, so not really anything that things that I would have to look up and learn myself.
Okay, great. And I hope you will consider, joining our future meeting in the future. So should we open mic for? Yes.
Yeah.
Open mic for Jacqueline, please.
Okay.
Hello, Jacqueline.
Hello.
Hi.
Hi, it was a great meeting. I really enjoyed it. And like the other person just said, I felt like I learned a lot. I just want to get out and practice some of it.
Yes.
I have one question. The acronym CAGR.
Oh, yes.
I didn't find where that is.
It's compound annual growth rate.
Compiled annual growth rate.
Compound.
Compound annual growth rate.
Thank you so much.
Welcome.
Mhm.
Any other questions, Jacqueline?
No, not at this time. Just thank you so much. Thank you.
Okay. Please join us in the future if you are available. Okay, Marilyn.
Hi, this is Marilyn. Thanks so much for letting me attend. I'm in Ohio and we're thinking about starting an online club, so it was interesting to see how you conducted yours.
Yes.
So thanks for letting me attend.
Sure, of course. Yeah, I just see your comment on your registration form. And let us know if you have any questions about forming a online club. So
okay, thank you.
Yeah, definitely share some lesson learned or experience and knowledge. Yep.
How long has your club been in existence?
This will be 2016, May 2016. We formed, launched our club.
Okay.
Yeah.
Good.
Yeah. Jay is the founder, one of the founding members. Yeah. Thank you, Marilyn. Hope you join us in the future. Patricia. Hi, Patricia. Hello.
Let's see what it says. She is this triangle. What does this triangle say? Maybe she doesn't have mic. You can text in the questions box or you can email, or if you have any questions, Patricia.
Okay. So Jay, did you stop recording?
Oh, I